Hey guys, welcome back to the video. Today is going to be the first in a two-part series where we discuss limited companies, and we're going to start off thinking about private limited companies, and then in the second video we'll move on to public limited companies. Now, limited companies offer owners in a business advantages over and above what they receive by entering into a sole proprietorship or a partnership. So we'll discuss those advantages, as well as how private limited companies differ to public companies, how they're structured, what some of the disadvantages are, as well as the advantages. So yeah, let's get into it. Okay, so before we focus in on private limited companies specifically, let's have a little think about how limited companies, both public and private, offer advantages to business owners over and above what's offered through sort of a sole proprietorship or partnership structure. So one of the main advantages is the ability for the owners to raise significantly larger amounts of debt and equity capital, financing to help speed up growth. The pools of capital that are available to companies and corporations is just so much broader than what is on offer and what's available in sort of unincorporated structures like sole traders and partnerships. And shareholders in companies can get much more comfortable with sort of the firm taking on higher and higher levels of debt. So that's the first sort of key advantage. Secondly, limited liability. So all the shareholders have limited liability. So if the company fails to meet its debt obligations, then creditors can't go after the shareholders' personal assets. The maximum amount that a shareholder could lose is the amount of capital they initially invested into the company. They can't lose any more than that. So that's the benefit of limited liability. There's clear separation of duties. So typically in a company, the shareholders will appoint managers to act on behalf of the shareholders. Not always, but quite commonly, the shareholders aren't involved in the management. They'll outsource the CEO, CFO duties to someone else, which will be overseen by a board of directors, and we'll touch on that a bit more in a moment. And then finally, there's fewer restrictions on the number of shareholders that are allowed to take an ownership stake in the business. Obviously in a sole proprietorship, there's only one owner allowed. In partnerships, there's upper limits on how many partners there can be in the partnership, whereas in a company, there's no upper limit on the number of shareholders that the business can have. And there's also greater ease of ownership transfer. So having a share structure allows greater liquidity and an active market where ownership interests can be transferred between different market participants, buyers and sellers of the company's stock, which you don't get in a sole trader or partnership structure, because they're highly illiquid stakes in those businesses. So yeah, as I said at the top, in most jurisdictions there are two types of limited companies: private limited companies and public limited companies. So for the sake of this video, we're going to focus in on private limited companies. So let's do that. So private limited company is a structure that provides limited liability for shareholders, and those shares are privately held by a small group of owners or smaller group of owners, and not freely traded nor available to the investing public. So that is really the key distinction between a private limited company and a public limited company. Private limited company shares are always held within a smaller group of shareholders. They're not traded on an exchange. There's no active market for those shares, and then they're certainly not available for the investing public, whereas public limited companies have the option to list on an exchange, which creates a liquid market with price transparency, volume transparency, and allows secondary trading of of the ownership interest in the company. And private limited companies are similar to limited partnerships, but the key distinction is that they offer limited liability for all the owners in the business. But you think back to a limited partnership, you had the general partners and then you had the limited partners. The general partners had unlimited liability, whereas the limited partners had limited liability. In a private limited company, all owners have limited liability. So that's one of the key benefits. The owners are formally known as shareholders, as they own a proportionate share of the company, and those shares represent a percentage ownership interest in the organisation. So yeah, I think probably quite common with the share structure. You purchase a proportional ownership stake in the company, which is represented by a share. So by injecting capital into the business in return, as a shareholder, you receive a share in the firm. So share structures allow for easier transfer of ownership between different shareholders, and they also create a clear distinction between the roles and responsibilities of owners and managers. So the owners are defined by their ownership stake in the business, and they appoint managers on their behalf to act in their best interest. And yeah, just to hit that point home, it's private, meaning the shares are not traded freely and not available to the investing public. So you can't go out and instruct your broker to purchase a share in a private limited company, because there's no active market for those shares. No one's selling on an exchange, so they're not available to sort of me and you. When it comes to sort of legal distinctions, in the eyes of the law, the business and the shareholders are seen as legally distinct. So yeah, the law sees the owners of the business and the company itself as two completely separate legal entities. There's no sort of business is the extension of the owner concept as you would find in like a sole trader. The law sees the company and the owners as two separate legal persons. So they've got separate legal identities, and this allows the shareholders to have that limited liability, which means the most they can lose if the business was to fail was their initial investment amount. So again, that's a massive benefit for being a shareholder. The most you can lose is the amount of capital you initially invested. You can't lose any more than that. And the risks and returns are pooled across the shareholder group based on each owner's proportional shareholding in the company. The more shares one shareholder holds, the greater the risk and rewards they're exposed to. So the more you own of a company, the greater amount of profits and dividends you receive if the business does well, whereas if the business underperforms, the greater the amount of losses you'll need to absorb. And then when it comes to management, so shareholders will appoint a board of directors, and the board of directors will oversee and manage the performance of the company. So basically, the shareholders are delegating management responsibility to the board, and then the board will do the same. They'll delegate the responsibility to the CEO, the CFO, the Chief Operating Officer, but they're still responsible for taking actions and operating the business in such a way that maximises shareholder value. So the objective of the board, the objective of the executive management team is to maximise shareholder value. They need to act in a way that creates value for shareholders, increases company value, and always act in the best interests of the owners. So yeah, the board will appoint a management team who sit below them in the organisational structure, and that executive management team are very heavily involved in the day-to-day running of the business. The board are slightly less involved. There's a mix of sort of independent and executive directors, but the CEO, the CFO, and the Chief Operating Officer are the day-to-day sort of contacts within the business who are doing the bulk of the work. And yeah, shareholders are often not involved in the management of the company. And the board are responsible for the authorisation of any dividends. So if the company's profitable, the board of directors need to sign off on whether the company's going to pay a dividend to its shareholders. Okay, so let's think a little bit about how this structure how this structure works. So we have some shareholders. Let's have 3 shareholders. And they're going to set up a private limited company. So the shareholders will provide the capital to the business, and in exchange they'll receive shares in the company. And then they will receive limited liability. And there's a legal distinction created between the shareholders and the company. So the company and its owners, in the eyes of the law, are seen as 2 separate individuals. But then what the company structure can do, and what the shareholders will do, is delegate management responsibilities to the board of directors, who in turn will delegate certain responsibilities to the executive management team. So that's how a private limited company structure works, guys. Shareholders will set up the company, they'll contribute capital to the company. In exchange, they'll receive shares and limited liability. The company structure creates a legal distinction between the shareholders and the company. So in the eyes of the law, they're separate legal entities. And then the shareholders will delegate management responsibilities to the board of directors, who will appoint a CEO, a CFO, to help carry out the day-to-day activities. And a few final points here. So private limited companies have restrictions, some restrictions in place on the number of owners, so the number of shareholders that a company can have, and a vote is required to transfer ownership from one shareholder to another. So the cap on the number of shareholders is higher than what you could get in a partnership, but there is still a cap. So you can't have an unlimited number of shareholders. And it's, again, because of the lack of liquidity, it's not as easy to transfer ownership in a private limited company. You have to go through a shareholder vote and have shareholder approval. Tax, so private limited companies are subject to pass-through taxation, like partnerships. So there's no corporate income tax due. It's a little bit confusing because it's a company structure, but there's no corporate income tax due. The shareholders will pay tax at their personal income tax rates on the company's profits. There's no tax due by the company itself. The company does not pay any tax on its business profits. And then, private limited company structures allow for good access to external financing, much better than what you can get in terms of borrowing and equity financing compared to sort of sole traders and partnerships, but financing is not as easily accessible as it is for public limited companies. Okay, so that's private limited companies. That's a quick overview. I'm going to make another video now about public limited companies, and that's going to contrast a lot of what we've discussed in this video. So do check that out. Yeah, hopefully that was helpful. Any questions, feel free to fire away, and I'll see you guys in the next video.